Hello. Hi, everyone. Welcome to today's webinar, which is about leveraging volatility for better investment decisions. Just a few housekeeping notes. This webinar will be recorded. The recording will be sent in a follow-up email to you, along with some offers from Sharesight and Pearler. Your mics will be kept on mute throughout, but please feel free to post any questions in the webinar chat throughout the presentation, and we'll endeavor to answer as many of those questions for you at the end. So just a reminder, Sharesight does not hold an AFSL, and we do not provide financial or tax advice. So the views expressed in this presentation are those of myself, Angela Thompson, and Jessica Goodall, and are personal in nature. So again, this is not personal financial advice, and it does not take your personal financial objectives or situations or needs in case. So for introductions, I'll start with myself. My name is Angela Thompson, and I'm the Senior Digital Marketing Manager at Sharesight. I'm originally from Canada, and I've been with Sharesight for about 8 years. I'm an avid investor, and I hold a diversified portfolio of ETFs and a few ASX-listed tech stocks. Over to you, Anna.
Thanks, Angela. Hi, I'm Anna Kresina. I'm Head of Product and Community at Pearler. I'm also Canadian and an investor myself. I co-host a podcast called ETFs for Beginners. So if you're a beginner investor, check it out as well. And I'm also on a mission to help communicate and educate people around personal finance, and am on my way to financial independence as well. And over to you, Jessica.
Hi everyone, I'm Jessica. I'm not Canadian, I'm from the UK, but I'm the Chief Customer Officer here at Sharesight. I've been with Sharesight for a couple of years. I am also a keen investor, albeit a sometimes lazy one, but yeah, very much a keen investor myself, and most of my investments are either unlisted assets or ETFs, a mix of ETFs, and more recently, individual company securities.
Fantastic. Thanks for that, Jessica. And just a little bit of an overview of who our companies are. So in case you don't know, so Pearler is an investment platform empowering everyday people on their journey to financial independence and to grow their wealth. And Sharesight is an award-winning portfolio tracker that provides performance and tax insights on all your investments. And there's an integration between the two products. So if you trade with Pearler, those trades automatically flow into Sharesight. So in terms of today's agenda, obviously the topic is volatility. So we'll cover off what volatility is, how to understand volatility in your portfolio, how to consider your investing strategy, how to keep your costs low, and how to have a money mindset. So we'll kick off with volatility. And I'll just start that as a side note, I was looking, I read an article yesterday and basically about how crazy the market is right now. And so just as a side note, the S&P 500 today is down almost 18% for the year. And that's the worst start of a year since 1970. And so that's pretty crazy. And the bonds market as well, and typically you would invest in bonds when the shares are down, the bonds haven't done really well as of late either. And I won't even start about crypto. So this is a really challenging time for investors, especially new investors if you haven't lived through a market downturn before. And that's why it's really important to understand what volatility is, how to interpret it in your portfolio, and how to take action. So with that, I'll hand it over to Jess. So Jess, what is volatility?
Thank you, Angela. Obviously, volatility can be, or the concept of volatility can be somewhat scary to us as investors, but in its most basic form, volatility is when a market or a security, so an individual company stock or an ETF, experiences periods of unpredictable and sometimes sharp price movements. Importantly, volatility often becomes a talking point when prices fall, as Angela just mentioned, but it can also refer to sudden price rises too. Now, I really love this graph on the next slide from Morningstar, because I think it really illustrates that volatility really is an occupational hazard for the typical investor over really the last 150 years. So this graph actually illustrates the value of a dollar invested in 1870, what that would look like now or in 2020 when this image was created. And as you can see, there's been periods of severe market corrections or market crashes and volatility throughout the period of this investment, which is this investor's life cycle, which is 150 years in this case. And one of the things that I really love about it is it nicely illustrates two key elements of investing, which is it's impossible to time the market, although we do have control of our time in the market. So that dollar has really, really grown and ridden out those waves of volatility over the life cycle that you can see here on the graph. So we know what volatility is, but what causes volatility? So there are 5 main themes, I guess, when it comes to volatility. With the first being political factors. So that might be conflict, or as we're experiencing currently, or upcoming elections, again, as we're about to experience here in Australia. It could also mean, it could also be impacted by government spending. So you might hear that being referred to in the press or in government manifestos as fiscal policy. So how much money the government is spending on various initiatives. In a similar vein, economic factors can impact volatility of individual assets or industries or the stock market in general. And that could be monetary policy. So things like the movement of interest rates, inflation, which we're hearing an awful lot about lately. It can also be consumer spending. So when we get stats from the Australian Bureau of Statistics that talks about how consumers are spending, that can also impact volatility. And of course, things like unemployment rates, which I'm pleased to say are at an all-time low, I think, here in Australia, particularly for women, which is great. So a little bit of a positivity when it comes to unemployment rates, that can impact volatility. And then looking at things in a less macro basis, we have industrial factors. So that might be regulation. There could be a new piece of regulation or legislation that's come in which impacts a specific industry. There could be industrial disruption. You know, there might be an entirely disruptive company or group of companies that come into an industry, or, you know, even perhaps usurp an existing industry. Something like when it comes to company performance, and volatility, it could mean something like a change of management or competitor disruptiveness. And then the fifth one, which I know is definitely front of mind for me, is the investor or market sentiment. So a few recent examples of that have been the GameStop saga a year or two ago, and more recently the tech sell-off. So volatility caused by investor sentiment, selling off stocks or even buying them with gusto, I suppose. So those are typically the main causes of volatility. So we now know kind of what volatility is and what causes it, but understanding it in your portfolio yourself is another matter altogether, and it can be somewhat complex. I'll aim to simplify things in a moment, but when it comes to understanding volatility, obviously the first place to start is measuring volatility. Now, there are lots of ways, several in fact, to measure volatility. And to me, all more complicated than the next. Although having said that, these different ways of measuring volatility certainly have their place. And if you are, I guess, less mathematically challenged than I am, you might want to look into some of these after the webinar today and familiarize yourself with some of them. But for me, when it comes to understanding volatility, I really like to apply a sort of 5-step process and keep it as simple as possible. So in terms of how I like to look at volatility within my own portfolio, I really like to start by keeping it as simple as possible. I then like to zoom out, and I'll touch on what that looks like practically in a moment. and then fundamentally really understand my performance and those price movements or perceived price movements as much as I can using data and technology. And then zooming out again to make sure that I really am contextualizing what I'm seeing when it comes to the volatility of a particular asset or industry or group of securities, to really truly understand volatility within my own investments and how that fits within my own circumstances. So the way I do that is I start by utilizing technology that's available for free within Sharesight for anyone. And I like to look at an individual asset and assess, going back to the definition that we spoke about earlier, is the price of this investment or this company moving up and down, and to what degree and how sharply? So we have something called the share checker in Sharesight. And in this example, I've popped in the security for the ticker for ResMed. And ResMed, for those of you that aren't familiar, are a health technology company. And I've looked at the volatility, I've looked at the price movements in the last year for ResMed. As you can see, looking over this time frame, there seems to be some fairly sharp price movements, both in a positive direction and in a negative direction. But this is over the course of a year. Now, when I'm investing or I'm choosing investments, I'm certainly not investing with a time frame of a year. It's a long-term endeavor as far as I'm concerned. So I really need to look at the data in the context of, my own investment horizon. So then I'll zoom out and look at it for the period of 10 years. And when you do that, you can see that for ResMed in particular, the increases in price are much less sharp. And importantly, you can also see that ResMed are paying dividends regularly, and that can be an indicator of a good quality company. So zooming out helps me to, I guess, look at things with a little bit more context, but also a little bit more calm, which for me is important as an investor. So I've looked at my individual security, either one that maybe I already own or one that I don't. And that's important to note here. If you are using the share checker in Sharesight, it doesn't have to be an asset that you already own. It can be used as a research tool. So I've zoomed out. The next thing that I really want to do is I want to understand my performance. So one of the things that I've embarrassingly fallen foul of as an investor in the past is I have made an investment, generated a return, although not in this example, we'll touch on that in a moment, generated a return and given myself a pat on the back and said, "You're an excellent investor, Jessica, well done, aren't you brilliant?" And that was before I started using benchmarking. And benchmarking, which again, you can use within Sharesight for free, enables you to understand your performance and the price movements of that asset in the context of the market at large. If you pick an index that kind of covers that, or another asset that you're perhaps wanting to benchmark to. So if we look at this example on screen, you can see that MasterCard, which is an asset that I do hold, and that's shown in the yellow line in the graph, that is clearly quite volatile in comparison to its benchmark. The prices are going up and down. Although the total return is slightly better than my benchmark. So you might think, okay, I'm happy with the trade-off of that volatility because the returns are better. However, I encourage you not to stop there. Again, look at the benchmark to understand how things are shaping up in terms of performance and price changes within the benchmark. But if we look a little bit more closely, you can see that the total return tells us another story as well. So obviously I'm still in my I'm a good investor mode, aren't I better than the benchmark, even though it's not a particularly well-performing stock. But then when you dig a little bit deeper, you can actually see that most of that total return is made up of a currency gain, which I personally have no control over, because when I pick an investment, I'm not necessarily picking a stock or an ETF with the movement of currency in mind, because so much of that is out of my control. So, you know, I'm looking at this now and okay, actually the total return is largely made up of currency gains, and I've taken on perhaps a little bit more risk than I would have done if I had chosen the VDHG, which is a very popular index ETF, which I also hold. But when you look a little bit more closely again at the data and at that total return, some of the VDHG asset the return is made up of quite a healthy dividend return. So it's really looking at the data, understanding the overall performance and what that is made up of, as well as the price movements, to really build that full picture, to help you make better decisions, or at least to understand what you're seeing on the screen in context. So touching on, and then I'll zoom out again. So let's look at this MasterCard holding. At the moment, I've held it for a year. It hasn't performed particularly well. And obviously we know that past performance isn't always an indicator of future performance, but it's certainly, for me as an investor, I like to look at past performance to understand the quality of management of the company, or you know, perceived management of the company. So for example, we look at MasterCard, and again, I've held it for a year, but when I'm investing, I'm looking at a much longer timeline, as I'm much more of a buy and hold investor. Let's look at what it's done in the last 5 years. Again, the price increases and decreases are mostly way less sharp in either direction, and we're seeing consistent dividend payments and rising dividends, which suggests that the company's performance is improving year on year, and that's great news for me as an investor over the longer term. So speaking of dividends, the other thing that's also important to think about and to use Sharesight data to understand is typically unfortunately, I'm not retiring anytime soon, so I'm not investing for income right now. So I will typically set up a dividend reinvestment plan, and due to the nature of dividend reinvestments and compounding in general, that can also play into the long-term performance and of my holding, in this case MasterCard, and Sharesight automates all of that for you as well in terms of the tracking, so you can really understand the impact of that dividend reinvestment on the performance and the price, on the performance of your assets, in conjunction with looking at the price changes that we spoke about earlier when we talk about volatility. So in summary, keep it simple. I mean, by all means, go ahead and complete the mathematical gymnastics that I'm not capable of, that we saw on the slide earlier. Always zoom out. That's one of the things that I really, really encourage us all to do, using Sharesight or Pearler or any other tool that you find useful, and truly understanding your performance and what that means in terms of the components that make up the performance. So things like currency, dividends, we're going to touch on costs later. And then again, constantly zooming out again to see, okay, what does this slice of data look like in reality when I apply the same time zone as my investment timeline? And of course, contextualizing. So I think contextualizing using the data that I mentioned and the reports that we have in Sharesight, but also contextualizing with anecdotal data. So, you know, Angela mentioned earlier the S&P 500 is down, and it's been a terrible start to the year for the S&P 500, but contextualizing local information that might be relevant to your holdings. I mean, here in Australia, we're really fortunate at the moment. I touched on low unemployment. That's, I think, the unemployment for women is the lowest it's been since 1976. It's less than the average of 4%, which is great. We've also seen, even within the S&P 500, that there are, I think, 13 companies that have over $1 trillion in cash on their balance sheets. That's great news for investors because it means that they'll be able to hopefully weather any storms that might be on the way with all of that cash. But it's also good news for investors from a pure P&L perspective, because largely that cash will translate to either increased dividends for investors or potentially even share buybacks. So just tempering the headlines with the facts as well, I often find useful when it comes to contextualizing and understanding volatility, both inside my portfolio and more broadly, I guess.
That's fantastic. Thanks, Jessica. Yeah, I think I would say whether you're a new investor or not, tracking those dividends is key. And again, whether you're a hardcore dividend investor and you only invest in dividend stocks, or whether you're just invested in other stocks that happen to pay dividends, really important to track those when the market's down, because sometimes that little couple percentage points of dividends that you've made can really help to show that you're actually not doing as badly as you thought you would. And again, most brokers won't show you that dividend number. So if you're not tracking it in some way, then you're really missing the full picture. So again, it's really easy to do in Sharesight, but I really encourage you to do it because it makes you kind of not panic as much, that you know that you're still doing it. And of course, currency as well, as Jessica said, if you're tracking, if you're owning shares or investments in other markets, that impact on the AUD is always going to impact, the bottom line. So really important to keep track of that stuff. But thank you, Jessica. Thank you for that positive end too with the context. I love it.
No worries. Thank you.
And now Anna's going to cover off what to consider when you're looking at your investing strategy. So over to you, Anna.
Right. So we often hear that it's important to have an investing strategy when you first start out investing. So what exactly does that mean to have an investing strategy? Well, it's basically an approach to investing that guides an investor's behavior based on rules and guides. And some of the things that you kind of need to take into consideration are the ones listed here. So risk tolerance, asset allocation, diversification, your timeline, and then also your personal circumstance. So I'll dive a little bit deeper into each of these in the next couple slides. So when it comes to risk tolerance, this can be in the form of how much of your investment is defensive, so more stable assets that you might hold. And this is like bonds, fixed interest, cash. And then the other side of it is how much of your portfolio is in growth assets. Again, this might be a little bit less stable, but often it's an expected higher return. So there's a lot of controversy around some of this, especially when it comes down to what the balance should be. In the past, it's been talked about that potentially you want to hold bonds around the same percentage of your age. Some of the theories around that have changed as well, but it is really important to think about your risk factor and your tolerance depending on your age, when you might retire, and what needs to be taken into consideration. So in terms of asset allocation, which is the next one, this includes looking at what asset classes you actually hold and what percentage of your portfolio is allocated to them. So asset classes include, again, cash, shares, bonds, property, precious metals, crypto, and thinking about what percentage you hold of each of these is really important. The thing is, we never know what asset class is going to perform well year over year. So ensuring that your portfolio is as diversified as possible can mitigate some of that risk and volatility. If you look at this graph that we have here, it shows actually which of the best performing asset classes are held by year. So as we've heard, it's hard to predict what the future holds. And if you look at this, you can see that in 2020, it was international fixed interests that are hedged and international equities that were the best performing. In 2019, it was Australian listed property. In 2018, it's small cap. So we can't really guess what the future holds. And that's why having a diversified asset allocation can mitigate some of that risk when it comes to volatility. We can only guess what happens in 2022. In terms of diversification, this includes various areas that you need to consider, such as sector, industries, markets, Also countries, how much of your portfolio is Australian versus global versus US equity. And also just that kind of those nuanced spaces in terms of tech and finance. How much is weighted within all of those different areas. It's also worth considering the currencies within your own diverse portfolio, which Jessica mentioned as well, and how that might play into your portfolio. So again, this comes down to trying to mitigate any risk by being as diversified as possible alongside this. When it comes to timeline, this is a very interesting one as well. If you're a newer investor, you might have a longer time horizon to invest. So you can actually kind of weather the storm of the volatility, of the ups and downs of the market, especially if you're a new investor right now and the market is a bit of a bear market. It's you're seeing a lot of red and negativity, you can see it in the minus. But the thing is, if you have a long time horizon, that should be less of a risk for you. However, if you're closer to retirement and you have a shorter timeline, you might want to actually allocate some of more of those defensive assets in order to kind of balance out that volatility. And if you have goals that you're planning for, whether it's financial independence or retirement or buying property, considering all of that within your timeline is really important. And we have goal setting on Pearler as well that you can kind of set up and actually track those timelines and help guide you in terms of your own investment strategy. And then the last one is personal circumstance. It's really important to kind of reassess what your investment strategy is based on some of that personal circumstance. So similarly, this can be you might have had a change in your life in terms of your income. It might have increased or a loss of income. Buying property is a huge one as well. Having a child or combining your finances, and then inheritance. And of course, winning the lottery, because who doesn't want that to play into their own financial strategy when it comes to their portfolio. But nonetheless, all of these are really kind of important because they can change the way that you might view your portfolio and your strategy within that. However, often it's kind of thought that if these big changes do happen, your strategy is kind of there to hold on for a longer period of time. So it's sometimes suggested to not make quick judgments or changes to your portfolio, but maybe wait it out for 3 to 6 months when these big changes happen.
That's great, Anna. Yeah, I think that's a really good point. There's lots of articles out there about investing strategies, and there's really good, like general guidelines that you can follow. But of course, those things can change a little bit as some of these things pop up. But yeah, I would say the best plans probably take that stuff into account. I mean, most people are probably going to buy a house or have a major purchase at some point in their life. So their entire investment strategy shouldn't change when that happens. It should kind of be baked in, I guess, with the long-term view from the start. So yeah, that's really helpful. What about keeping your costs low? What do you think about that, Anna?
Yeah, so there's two main areas in terms of thinking about keeping your costs low. We know that the market can be really unpredictable, and we can't really predict what the performance is going to be of the market on any given day. We don't know what it's going to do tomorrow or next week or next month or next year. But the only thing that we really can control is how much we actually spend. So that comes down to two main areas: management fees and brokerage fees. So let's talk about investment fees, essentially. So management fees. In the next slide, actually, you can kind of see that there's a very slight difference in fees, but it can actually impact your portfolio a lot. There's a few different types of management fees. You can look at management expense ratios, especially of ETFs. If you're working with a financial advisor who's managing your investments, they might have a fee, or there's also fees that are associated with your super due to a specific product that you're invested in. Sometimes these fees are quite hidden, so it's really important to know how much of your asset or how much of your costs are going to fees. And sometimes fees might seem quite small. You hear something like 1%, and it doesn't seem as big as 20% of a credit card fee, but really that percent can add up quite quickly. So if you're looking at this graph, the very top is if there were no fees at all associated to a specific investment, and over 30 years, how it would perform. The second one down is 0.25, and the third one down is 0.62 of the fees. So it doesn't seem like a lot. There's just a few basis points in difference. However, it's about $100,000 difference in what money ends up in your pocket based on these fees. And this is only a 30-year horizon. Imagine if this was 50 or 60 years, especially as people are living longer. It kind of can eat into your actual investments quite a bit. I know when I first started investing back in Canada, we have some of the highest management fees in the world. I had fees that were 2.5%. And you can only imagine how much that would eat into my actual investments. So fees are quite important. The other part of fees is brokerage fees. Again, it's important to kind of try to keep these as low as possible. This fee is associated to when you're transacting. So if you buy and sell, good rule of thumb is to try to have your brokerage fee lower than 1% of your investment cost. So if you're investing about $1,000, you would want your fee to be $10 or less. Pearler just lowered its own fees to $5.50 prepaid or $6.50 for a casual trade. And also you're able to mitigate any of those fees by referring friends to the platform as well. So it's just another way to kind of keep your fees low along that.
Oh, thanks for that, Anna. Yeah, I think that's really good. I mean, like we were saying, we've been saying this whole time, right? We can't time the market. There's not much that we have a lot of control over. But those management fees, I had those really high management fees in Canada too. It's pretty gross to think about. But yeah, those are really important. Again, they don't seem really big, but they do add up. And brokerage fees as well. And remembering that you pay them both ways usually, when you buy and when you sell. So you have to kind of keep that in mind as well. That's really great. And Jessica, can you tell us a little bit more about tax? Because we kind of view tax as well, right, as something that we can do to kind of keep more money in our pockets or be tax effective. Can you talk a little bit about that?
Sure. So I guess tax, unfortunately, for the most part, is a cost that is relatively unavoidable in life in general. However, there are certain things that I guess you can do in terms of how you manage the process of tax, which Sharesight helps with, and I'll talk you through that now. So the first thing is obviously outside of kind of working with your accountant and what Sharesight helps you track, index ETFs, they can be a tax efficient way to build wealth because they generally do pursue a buy and hold strategy as they seek to track a specific benchmark. Because of this, there's a lot lower turnover in ETF portfolios, which can minimize your capital gains as well as your brokerage potentially, and the distributions as well. All of these things are tracked through Sharesight. Now, with that in mind, you'd almost invariably be getting advice from or working with an accountant to understand your tax liability, or hopefully maybe even in the opposite direction. But generally, when it comes to the cost of managing your tax affairs, if your accountant is spending a lot of time gathering data on your behalf and putting that into a usable format, that can really blow out the fees that you pay your accountant to manage your tax affairs and give you the advice that you're after. Now, if you use something like Sharesight automates all of the record keeping for you. We mentioned the tracking of dividends and taxable income, as well as that all happens in an automated fashion within Sharesight. And we also have specific tax planning tools that your accountant can use, or you can use in conjunction with your accountant, to help you understand any unrealized CGT liability you might have, and what options you have to offset any CGT liability you might have with some gains with some losses within the rest of your portfolio. So that's something worth considering, thinking about the tax efficiency of your investments, working with your accountant in an efficient way to really minimize those costs, and working with your accountant to understand if you can minimize the cost of tax itself.
Perfect. Thank you for that, Jessica. Appreciate it. Yeah. doing the most that you can. So you're not paying your accountant to chase down dividend statements. That's a huge thing that we hear from investors. You've tried to hustle so hard to make money and kind of squirrel money away and invest it, and then you get hit with a massive tax bill. So I guess it's not just at tax time too, it's staying ahead of it throughout the year. So you kind of know what's happening, so you don't get that surprise from the accountant. But yeah, at least the accountant has everything they need. So you're not spending hours and hours yourself, wasting time figuring that out for them. Or you're not paying them to kind of fill in the gaps as well. So yeah, really, really good advice. Thanks for that, Jessica. And I think it's back to Anna now, to talk about having a money mindset and what that's all about. So over to you, Anna.
So most people have heard about having a growth mindset, which is the idea of wanting to grow, develop, change through hard work. And a money mindset is quite similar to that, actually. It applies to the same principles. It applies the same principles, but basically to finance. So it's what personal beliefs you have towards money and finances and what drives our behavior towards money. And allows us to change and adapt in order to reach our goals. So there's a bunch of important aspects in our lives that we might consider around money, and that's, are we savers or spenders? What kind of habits do we want to build around money? Do we want to remove any emotional triggers so that we can actually hit our goals instead of being reactionary? And also understanding our why. So why are we doing what we're doing? Is our goal financial independence, or is our goal to set our children up for a better future? Often kind of unpacking those personal beliefs will help us be better investors for the long term. And when I talk about the long term, having a long-term focus is really a part of that money mindset, because it's about habit building over a long period of time. There's no get-rich-quick schemes when it comes to investing. Well, there might be, but for very few people. So having a long-term focus is really important, which kind of brings me to the next slide. Long-term investing paired with a very diverse portfolio historically almost always outperforms the market. Whereas statistically, having short-term trades can actually hamper your returns. So I love hearing of these long-term focused stories, and you may have heard these before, but I'll share them nonetheless. Warren Buffett had a very famous bet that he made with a couple hedge fund managers on Wall Street, stating that the S&P 500 index fund will outperform hand-picked stocks of hedge fund managers. And over 10 years, surprise, surprise, guess who won? Warren Buffett did. And it was obvious that his focus on passive investing instead of active investing in the end was a better strategy. Similarly, he was quoted stating that once he passes away, that the trust in charge of his estate invests 90% of his money into the S&P 500 for his wife. So again, a long-term kind of focus in index funds specifically. And so when it comes to that long-term focus, and also being a bit more passive, Fidelity conducted an internal performance review of customers that they had, which had the best performing portfolios in 2003 to 2013. And what they found was the best performing portfolios were actually of people who have passed away or who are inactive investors. So again, not having a strategy, sticking to it, long-term passive is really a bit of a win. And that's something that we talk about at Pearler quite a bit. It's not about being a casino. It's really on the long-term habit building that we do. Which brings me to consistency. And consistency is a huge part of that money mindset, right? We want to take out the emotional toll. So when we see the negative in our portfolio, that we don't freak out and think, hey, we should sell, or I should stop investing, or I'm going to wait till the market is better. All of those things are very reactionary. And again, talking about having a strategy in place that kind of keeps you consistent is really helpful. The concept of dollar cost averaging is a really important one. It's as people may have heard, it's about time in the market instead of timing the market. So the idea around dollar cost averaging is that you purchase your shares or ETFs or whatever it might be, regardless of if the market is up or down. So it allows you to, over time, have an average price that you've paid for your investment. This means that over that course of time, you haven't timed the market in terms of trying to get it at at a, at a cheaper price and so forth, but instead you're just doing it consistently. So you haven't missed any opportunities. And let's not forget the benefit of compounding and dividends over time. So just keeping consistent with that dollar cost averaging is really an important concept when it comes to consistency. Also, automation. A lot of people automate their bills. My credit card gets paid every month. Why not do the same for your investments? At Pearler, we have one of the only platforms that you can actually invest and set up your investment strategy and not worry about it. So you can line it up with every paycheck or monthly, and just have it kind of work with whatever portfolio you want to invest in. And then similarly, roundup. So having some spare change that you want to continuously invest, you don't even notice it. It's just being consistent. You go out and pay for a coffee. It's, now in Melbourne, $9.80 or whatnot, that 20-cent difference, you can just put that aside and invest that and doing things like that actually kind of helps you with your own money mindset. It helps you focus on that long term. It doesn't let you be emotional, and it just kind of allows you to be a better long-term investor.
Fantastic. Yeah, thank you for that, Anna. I think it's really important to remember that those consistencies and those little things that just kind of add up over time, and the set and forget. It is pretty morbid that the dead are outperforming the active investors, but yeah, it just goes to show it's kind of like set it and forget it and don't touch it, and you'll do better in the long term. That's great. We've got a few offers for you. We'll just mention them here briefly. These will be emailed to you as well in the follow-up email, which will also include the webinar recording. But yeah, Sharesight Pearler's got a $650 offer. So you can use promo code community and get $50 Pearler credit that you can use within 6 months towards some trades. And Sharesight also has an offer, which is to our new or free existing users. You can save 4 months when you upgrade to a yearly premium plan. Now, just to note, Sharesight is free. You can track 10 holdings for free in Sharesight for life. But if you do want to upgrade to track more holdings and get more advanced features, then that's the offer for you. And as a bonus this time of year, it's always good. Sharesight is maybe tax deductible as well if you derive income from the share market. So just confirm with your accountant, but it is tax deductible in most cases. So you want to upgrade and pay that invoice before June 30th. Then you can hand that over to your accountant and write it off. So that's kind of a little bit of a bonus as well for this time of year. So that's our webinar today. We wanted to thank you, first of all, for your time, of course. We do have a few questions as well. We've got a little bit of time, about 15 minutes. So I'm going to go through some of the ones that came through during the registration, and I'll go through some of those, and we have a few as well in the chat. So we'll go through those, but I'll start with the ones that came through from the registration. And I guess I'll just let me know, Anna or Jessica, which ones you feel is best for you. But I'll start with, I guess this came up a lot today, the dividend question. So maybe Jessica, what about dividends? So how do you reinvest them, and how significant could that be to your long-term investment worth?
Yeah, so I guess how you reinvest them would be typically through your broker. So I know that Pearler have some options to set that up. You can track them in Sharesight, and as with any investment process that involves compounding, that can have an impact on your net worth over time, because obviously each time you reinvest a dividend, you're getting the advantage in a roundabout way of dollar cost averaging, because you're buying shares with that dividend at the market rate at the time, and you're also getting the benefit of compounding of that total amount. So you kind of get the double benefit when it comes to dividend reinvesting.
Yeah, that's great. Also, if your broker doesn't do it, you might have to do it through your share registry. So it just depends on what your broker provides. So ask your broker, but if they say they don't do it, then it would be through the share registry, and you just log in, and it's like one click. It's really easy to do. And you don't pay brokerage fee as well, which is the other benefit to doing a DRP or a DRIP, as they're called overseas. So yeah, I think that's great. What about maybe another one for you, Jessica? Should I invest domestically or internationally? How do I know which one to choose?
Well, I can't answer that for you, unfortunately. I think I mentioned that I'm not an advisor, but I think, again, it's worth looking at all of the things that Anna mentioned. What is your tolerance for risk? what is your capacity for risk? What does your own investment timeline look like? And how does that align with your money mindset? And if you take that approach, and when you're viewing either international or local holdings, you should be able to make a decision. I personally like to invest in a mix because I like the diversification that it brings. Obviously, not having everything invested in one geography that could potentially mean that that those different factors that impact volatility that we mentioned earlier might be less problematic. But of course, it really depends on your own personal circumstances. And if in doubt, seek advice.
Yeah, that's great. Thanks. I can ask both of you this. I'll start with Anna, but Jessica, feel free to chime in as well. So where are the best places that you use to read up on daily, weekly, or monthly to understand what's going on in the share market?
Yeah.
Jessica, or Anna, go first. Sorry.
Go ahead.
Oh, Anna, no, after you.
I was going to say is that for myself, because I'm quite passive, I like to do my research up front and make sure that my portfolio is quite diversified. And I think I talked a little bit about that, ensuring that it falls into that. And once I do, and once I'm happy, I'm a predominantly ETF investor. Once that's kind of set up, I try to actually block out the noise. I find that Elon Musk tweeting is a huge distraction of what my strategy is, and I don't want to be speculative in a lot of these spaces. Now, if there's something that aligns with my own personal beliefs, whether it's an ESG, an ethical fund of some sort, I might include that in my strategy, but I kind of try to block out the noise. So I don't try to go for all of the daily hot tips. I just try to kind of focus on the long term. That being said, though, I would say that Morningstar is a great place to get started in doing some of that research. There's lots of amazing podcasts, especially here in Australia, that you can check out. You can check out ETF for Beginners, which is the one I co-host. But there's amazing resources like Rask and Equity Mates and so forth that you can look into. So I would definitely say go read and do that research and see what aligns with your own strategy. Because again, like I said, I prefer to take the emotional side out of it for me.
That's great. Yeah, for sure. What about you, Jessica? Any tips?
So I guess some of the things that I've been enjoying lately, or rather, well, to be fair, the first one is the Australian Financial Review. And the main reason I like that is not necessarily to understand the trends of the share markets, because like Anna, the trends are less of a concern for me because I'm thinking long term and in a reasonably passive way. But I think that the traditional kind of news outlets like the Australian Financial Review here in Australia and the Financial Times which is based out of the UK but has more of a global kind of bent, is useful because they do a really good job of explaining the impact of macro trends on the share market. So they'll do a great job of explaining why one particular political party's manifesto may or may not be better for the economy and therefore for investors. And I really like that, find that really interesting. And that's not always information that you can get just anywhere. The other thing, and again, ETFs for Beginners, as Anna mentioned, and Equity Mates, I really find those really enjoyable to listen to. But in terms of thinking about money mindset and just emotions around investing, I've actually been reading 2 books lately which are not necessarily about investing, although they do feature investing as a topic. And the first one is Thinking Fast and Slow by Daniel Kahneman. Really useful to just kind of, I guess, clarify my thoughts and separate them from emotions potentially when it comes to thinking about investing. And then also Anti-Fragile, which I'm only a few chapters into, but that is essentially a book about things that gain from disorder. And I think when we're talking about volatility, it's probably an interesting thing to learn about. So not necessarily pure finance books, but I think kind of related. And of course, Warren Buffett, anything that he's written or anything that's anything that's been written about him is always, I think, really useful. And I find everything that he and Charlie Munger have to say very, very wise.
That's really good. Yeah, I agree. I mean, I think there's been a few questions here about diversification, so I think I'll just answer them within my own answer for this question too. One of the things I struggled with when I first got into investing was I knew I wanted to diversify. That had been drilled into me, diversify, diversify. But actually, there aren't a lot of articles or places that tell you what you should diversify, like what your asset mix should be. And again, it comes back to personal circumstance. So unless you work with an advisor, you kind of have to figure it out. But I still struggled a little bit with that. So some of the things that did help me was actually signing up to the newsletters of the ETF providers. So I find that Vanguard, Beta Shares, they do a really good job. Not every article is going to, matter to you or be of interest, but now and then they'll have a really good article or a webinar. And I learned a lot about that just by listening and kind of hearing the lingo and looking things up and digging deeper. So I do find that they do a pretty good job with that content. And I also use Google News as well on my phone. And because I do own a few little ASX stocks, I have chosen to follow those companies directly in Google News. So I do get notifications on them. Motley Fool tends to be really quick. So if something happens with a stock, Motley Fool will get on it and write an article about it. I'm like Anna, I'm in it for the long term. So I'm not making decisions on that. I'm not selling and panicking. It's just like, oh, that's why that stock is down today. Okay, interesting. And usually, to be honest, with tech stocks, it isn't even that company that's done anything. It's just the market. So zero is down because the US tech market is down, then zero over here is down. But it's just interesting for me to be like, oh, okay, it's just because of that. And I just kind of, I like to stay informed, but it's just more about that. So yeah, I guess just following those ones that you're interested in, but again, kind of keeping that long-term mindset and not panicking because of it. So that's good. Let me see here. I have a couple ones. Oh, I just want to say too, there was a note about, there was a question about benchmarking. Benchmarking actually is a premium feature in Sharesight. So you do have to upgrade to, I think, at least starter plan to get access to that one. So yeah, that one, a couple questions about that. I just want to cover that. There was a comment, Anna, about your $9 coffee. That's okay. What about, what is the name of the second book that you mentioned, Jessica?
It's called Anti-Fragile, Things That Gain from Disorder. And I've actually put the book to
You've shared it there. Okay, awesome.
The chat.
How much time do we have? About 6 minutes. What about, I don't know, this is one that come up. So short-term investing options in a recessionary environment. I think you flagged that one, Jessica. Exactly.
Can't really recommend anything on that basis. I prefer to think about investing options as long-term. And, as we've illustrated with lots of the things that we took you through, I don't think anyone really knows what the short-term investing options are. Depending on your circumstances, you might want to revisit your strategy perhaps and assess that against your current money mindset. But yeah, who knows?
Yeah, same thing. There was a question too about bonds. Is it a good idea during volatility?
So I can talk to that a little bit. And
okay.
Obviously, I don't necessarily know if it's a good idea for your personal circumstances, but the way that people have used bonds historically for two things: capital preservation. So typically, if you purchase a bond, it's not going to necessarily be worth less than you paid for it, literally, maybe not necessarily in real terms, but literally. And the other thing that people have purchased bonds for historically have been for income purposes. So if capital preservation and income is your objective, then it's worth researching bonds, I would say. And of course, seeking advice and making sure that it aligns with your circumstances. But that's typically the purpose of bonds, I guess, when it comes to investing. And obviously everybody has a different risk strategy when it comes to bonds.
Yeah, that's great. I guess I hadn't thought about that. That's the whole point. It's protected, so it can never be less than what it's worth. So that's really good. A good reminder even when they say the bond market's bad, it's never as bad, I guess, as the others could be. So that's a good reminder. There was a question here about, is thematic ETF investing necessary? Do you want to speak to that one, Anna? I have a thought on it too, but I didn't know if you wanted to speak to that one.
You can go first if you want.
I can go? Okay.
Yeah.
Obviously it's not financial advice. I think it comes up a lot, thematic ETF investing. I think some people use it as something that they might be interested in, something that they might want to follow a little bit more closely. It can give you a little bit of a hedge. Personally, I have a background in tech and kind of data centers and cybersecurity. So have a little bit of thematic ETF in my portfolio. And again, it just makes me kind of follow that news more closely and kind of keep an interest to it. So it's a neat way, I guess, as an ETF investor to feel as though you're kind of taking a more active approach, but you're still in an ETF. So it's still really, broad and indexed. So that's my kind of take on it, but it's certainly not necessarily necessary. And it's just, I know it comes up a lot recently, and there's so many very particular ETFs now that get into this stuff. And it's not to say that they're all great, and you have to watch those management fees, I think, as Anna said. So yeah, I would say, again, do your own research, but that's my kind of thought on it. About you, Anna?
Yeah, I was just going to add, like, thematics are really can be a really great way to complement your portfolio as well, especially if there's something that you feel passionate about and you want to align with that. And I think it comes back to that kind of value investing, especially if there's something that you really value and you want to be more about clean energy, or you want to be focused on more battery focused tech, or you know what I mean, as opposed to oil. There's ways to kind of complement your portfolio that way. So it's great that thematics are there, but again, check out the costs and make sure that you might be investing in those companies if you hold ETFs already. So being able to ensure that you're not overlapping too much if that's not what you want to do.
Yeah, that's a great one. There's one here about how to analyze an ETF before investing in terms of performance. Obviously, those management fees are always going to be on the ETF provider's website, so you can look at that. But if you want to look at performance and how it's done over time, you can use the share checker, as Jessica said. So you can always check it and go back a few years. If you're on an upgraded Sharesight plan, I do this. I use one of my portfolios as a watch list. So when I'm researching ETFs, I'll put them all in a watch list, and I'll say, I pretend that I bought it 5 years ago, $1,000 trade, and I'll stack them up next to each other, and I can go back and see how they did. As Jessica said, past performance is not an indication for how they're going to do, but it gives you an idea. This guy pays more dividends. This one's an American ETF, so there's a US currency component. So it's a lot easier than having all the fund manager web pages open and trying to kind of figure out, because sometimes it's apples and oranges how they calculate it. So I find that really a helpful way to do your research when it comes to performance on that one. I'm trying to see if there's anything else here. There's a few. There's so many.
There's also one about account holders, so I could maybe just talk a
Sure,
little bit
yeah,
about
go
that
ahead.
when it comes to Pearler. If you're signing up to Pearler, we have two different products. We have a shares product, which is CHESS sponsored, and therefore you will sign up through a shares registry, and you are actually the owner through that CHESS holding. So I just wanted to explain that that's one of our products, that we refer to as Pearler Share. The other product that we hold is Pearler Micro. So it's like a micro investing platform as well. It's more suited for people who are new to investing and maybe aren't ready to purchase ETFs because they don't have $500, but are happy to start with $5, $20, and so forth. And that one's kind of held in trust in your name. And it is your money. It's not as though Pearler holds that money, but it is kind of set up in a slightly different way. In the same way that if you might set up a minor account, again, for that minor, that would be in trust for that minor, but it is often there's tax implications around that as well. So I just wanted to kind of talk about the two different products and how they're held. So our share product is a CHESS sponsored product, and you will be signed up to share registry, and you'll have to go that way. So just explaining those two different products.
That's fantastic. Thank you for that, Anna. And it looks like we're out of time for today. Sorry we couldn't get to everyone's questions. There were so many, but definitely encourage you to try out Pearler and Sharesight. And you can always ask us questions as well once you're signed up within our chat features within our products. So yeah, thank you so much, first of all, to Anna and Jessica for your time today. And for all of you who registered and joined and added questions in chat. It was really awesome. And yeah, look forward to seeing you soon. So thanks again, and stay tuned for the email, which will have those offers from us as well as the recording from today's webinar. So thanks very much.
Thanks,
all the best. Bye guys. Thank you.
Thanks to you, Angela.